Hi, welcome to the show. Today, I've got some ideas of how to trade in this sort of range-bound market. Let's talk about what the market's doing and not doing. Let's talk about what trades are going on, and we'll take a look at the VIX too. That all coming up and more coming up right now in the Short Vol Show live. Stay with me here. Okay, and I guess I got to start streaming in a more regular fashion. Like I just come on at random times, and it's hard to promote when you're just coming on at random times. So I'm going to make that one of my New Year's resolutions to get more regular in the streaming. It seems like I was thinking about it yesterday, and we had that whole December, January where we're like, oh, the economy is going lower, this and that, and then we've bounced back from that, and now we're in this spot. And if you back up the chart a little bit, this could turn into something where we are just going sideways for an extended period of time here. I mean, we look here, if you chop this off until like January of last year, or even if you go back to like last summer, like June of last year, and you look at the market going forward, we've made little progress. It's just kind of choppy around. And what if we continue to just chop sideways? That's a distinct possibility. And so when we're in a market that's either rallying slowly or kind of moving sideways, you get away from where all stocks are moving in tandem with each other, and you get into a situation where individual issues are in play, and which stocks you pick are important, and individual stocks have the ability to move on news and move independently of different stocks in their industries. Now, some industries move more together than others, and I think they call that beta, like how much of a beta a stock has to the rest of the market. So, for example, if a stock has a 1 beta to the S&P, that means if the S&P is up 1%, the stock will be up 1%. If it has a twice as much beta to the S&P, then S&P goes up 1%, the stock goes up 2%, that sort of thing. But I put a play on which I publicized shorting UVXY. UVXY, we had a pop yesterday. It was up. Let's take a look at the chart for the 5-day, okay? UVXY, and I'll move slightly out of the way here, had a little pop. It went from, and that's not UVXY. Hello. UVXY had a pop where we went from like the 48 range overnight, ripped up to 50, and then during that day got up to like 53 and change, right? So I ended up selling up in here the 55, 57 call vertical, just like less than 2 weeks out. So a short-term, short play to say, okay, this is going to revert back from this pop back down at some point. Put that trade on and made some money on it, which was great. Great, made a little money. Took it off because in this market, stuff's moving all over the place. So you make a little money on a directional play, take it off because it could just as easily be back up to 55 tomorrow. Who knows? But I was looking around, and when I'm looking around for ideas, a lot of times what I do is I go to barchart.com. So let's just go there right now and take a look for a second. Barchart.com has option screeners, and I know that there's more sophisticated option screeners out there in other places. But I like to go to barchart.com. I go to options, and I look at highest implied volatility. And then it's going to give us a list. Now, we want to kind of hone down this list more than just that. So let me show you what I mean here. And I'm just want to look and see how much in the way I am here. Okay, let me move over here. All right, so I'm going to go down the list, and when you notice as we go down the list here, it says NVAX. Okay, price 226. Well, a stock that's trading 226, there's not going to be that many option strikes that are really in play that we can have a lot of fun with. So that's going to be crossed off my list. Any stock below, like let's say, I don't know, $10 crossed off the list immediately. So IMGN, $5 off the list. And then we get down here to EA. Well, that's interesting, a $95 stock. And it's got this option, the 92 call, that's 250 vol. However, 0 days to expiration here. So that leads me to believe that this is either a very wide market that kind of got quoted or something like that. So since it's 0 days to expiration, it's showing this huge volatility, that leads me to believe that this is not a situation that we can work with. But let's quickly go to EA just to make sure. All right, so we pull up EA. And in Thinkorswim here, well, we can see that the stock's all over the place, EA being Electronic Arts. But let's go to the options screen, and we see volatility in the options is in the 40s. So, you know, quoting one call that was a 250 vol, that's obviously an outlier that's not significant for us. So what we do, we go back to our barchart.com, and we keep going down the list. Okay, so then I see this... next, I see ICPT, $118 stock. And this put, it's a 217 vol. What's ICPT? I don't know. Let's look it up. So I go over here. ICPT. Okay, pharmaceutical. So that's a biotech pharmaceutical stock. All right. Let's take a look at the chart real quick. We see the chart. It's kind of in a mid-range of the chart right now. And let's take a look at the options. Okay, as we look at the screen, I'm going to move once again out of the way here. I kind of have to do this sometimes to stay out of the way of what I want to be talking about. If we look at the screen here and we go over to the right, you're going to see different volatilities per month here. Okay, and you see Feb, front month, 7 days to go, 200 volatility. 14 days to go, 197 volatility. And then back out in SEP, we're down to like an 80 volatility. The Jan 700 days away, 60 volatility. So that means that, you know, you can buy a 60 volatility out in this Jan and sell, a 200 volatility up close. That sounds like a big spread to buy a 60 and sell a 200 seems like an interesting spread. Now, there's some other things to think about here. One thing to think about is anytime you're buying far out options, you have to be wary of a cash takeover, okay? Because if a company is taken over for cash, then all the option premium is all going to go to parity. It's going to be like expiration happened for every option, every date expiration. Expiration just happened at that moment that the cash deal happened. So, for example, if we just looked out to this Jan with 700 days to go, the Jan 195 calls, if you bought one of those for $24, if this got taken over for, like, let's say it got taken over for $140, these calls would go to zero. Okay? The 50 calls, $35, those would go to zero. So if you bought one call for $3,500, it's going to zero. So cash takeover, not really that likely, but something to just have in the back of your mind as a risk inherent with something like this. But when I look at this, I say, okay, well, so let's not buy Jan 700 days out. That's not necessary, but we can go and buy like SEP. Look, SEP here, 85 volatility. We could buy some SEP and maybe sell some, I don't know, like March against it. Or even, some of this Feb, which is really high. Now, to me, when I see, okay, Feb really high volatility compared with this way back month stuff, I think, okay, there's probably, if this is a biotech stock and I haven't researched it at all, there's probably some sort of binary event coming out, like a drug approval or earnings or something's happening that's making this stuff be cranked in the front months. So more research needs to be done. But, and we can also look at the liquidity of this issue. You can see if you look quickly there, that I actually have a position on here. So I don't want to try to give that away too much, but I looked at this for 5 minutes and I put a position on, and I'm going to talk to you about why I did that. But let's look quickly here at options time and sales, and we're going to see a buy rate traded 3,500 times. Wow, that's a pretty big trade for this one, it seems like. April put. So somebody bought puts and stock. I think somebody bought puts and stock, which would be a synthetic call, but I'm not sure. They might have sold puts and sold stock. But kind of a big trade. If we look at statistics, we see today's volume, 9,000 options. Implied volatility, 52-week high, 197. So we are at the high in volatility. Current IV percentile, 98%. We are at the highest for volatility for this. So what that means is that once this event happens, whatever the event happens to be, volatility will probably come in, and it will probably not only come in the front months, but also in the back months. So even though September's 80, September will probably go a little bit lower, but the front months probably will come in even more. But what I looked at when I saw this, I said, well, let's do a calendar. Let's buy some SEP and sell something else against it. And I just started trying out the different calendars. So I said, all right, let's put them in our Analyze tab. So let's look at, and I still have this set to straddle, so let's put this back to single. Let's look at buying. What stock is 118. So let's look at the money in June, for example. So what if I buy the June 120 call? Well, what's it trading for? 30 bid at 33. And I sell maybe the Feb 22 call against it. So I'm going to go to the Feb 120 call. I'm going to hold down control and click on the bid, and that should and I'm in Analyze right now, so this trade should come up under my Analyze tab as a spread. And so let's just try that again. I guess I kind of messed it up. So selling Feb 120 call. And then go ahead and buy June 120 call, for example. Okay, so now I have this ticket set up here where I'm buying a June 120 call and I'm selling a Feb 120 call. And I can see that if I do that once, it costs $15, thus $1,500 each time I do this one trade. And I can see from the Greeks up above that each time I do this, I'll be collecting it's showing collecting $40 a day in theta. Okay, so I'm setting aside $1,600, and to buy this calendar, it's collecting $40 a day in theta. Sounds like a good ratio, right? You put $1,500 to work and you collect $40 a day from it. That sounds pretty good to me. But let's see. What if we switch this around a little bit? What if we said, okay, well, instead of buying June, let's buy the farther out Jan. Okay, so now we're paying $2,100 and we're collecting 46 a day. So it's sort of comparable. What if we take this Feb and we move it out a little bit to like end of March? Okay, so now it only costs $850 per spread, but we collect $22 a day per spread. But, you know, maybe we could do 2 spreads instead of 1 for less than $2,000, and then we'd be collecting $45 a spread. The point here being, because of the disparity between the volatility that we would be buying and the volatility that we would be selling, there's a decent amount of theta to be collected every day. And if you notice, it's showing, even though we're trading pretty much the at-the-money option here, stock's 118, we're trading the 120 strike, we're showing a long delta here. And you kind of want to note that, but you can start to run your sheets ahead a little bit and see what's going to happen to that delta. So if I were to move my sheets ahead a couple days, that delta is going to get a little bit longer as we move toward the strike, but not a huge delta, under 20 delta. So what does that mean? It means that for each dollar this goes up, you will make, $8 at the current delta we had. Every dollar goes down, you'll lose $8. So pretty manageable delta at this moment. And each day you're collecting a little bit of theta. So I think it's an interesting trade. And you know what? We just found it out of nowhere. And there's no volume right here. So small volume. And it's quite possible that the people who have their computers set up to trade this thing are not lining up their calendar spreads to see what makes sense. And so therefore, because we are looking at, when they're setting up their option screens, they're looking at supply and demand in the options, what's happening, maybe supply and demand for other options in their portfolio and similar stocks, all these other things. But we're just looking at it through the lens of calendar spreads, and you can find some really good possibilities here. I mean, I like the idea of setting aside less than $1,000 and collecting like 25 a day. That sounds great. It's like you have a second job that pays you 25 a day, and all you have to put up is $1,000. Well, what if we kind of multiply this out a little bit? What if we put up, we do 10 of these for $8,600, okay? Now we're collecting $250 a day. So you have 10 grand to put aside, and you can collect $250 a day from that 10 grand. That sounds like a good do, doesn't it? All right, so what's the risk here? Well, the risk is that this is a long Vega trade because remember, we're buying a farther out option. Farther out options are more sensitive to volatility changes than closer ones. So we are long Vega. That means if, the one binary event happens and makes a big move one way or the other, our delta is going to hurt us, especially now to the downside a little bit because this is making us long a teeny bit. The delta is going to hurt us a little bit if we have some huge move, A, and B, the Vega is going to hurt us a little bit if we have some huge move. But each day we're collecting that theta. So, we've got that little insulation of being paid every day a few bucks. Now, if you put this trade on, you're not going to see it being paid exactly what it shows on the sheets here. It's going to happen sporadically. It might be like a couple of days it goes against and then money comes in. But as time goes by, you will collect money on this trade. And I would encourage you to try out some of these calendars. They can be really fun to do. I closed my UVXY and I just jumped into one of these calendar spreads, and I'll tell you which one I picked here on this stock, ICPT. And, you can do this on other issues. The reason I picked this high volatility one is just that the dollar numbers are better when you have buying a very cheap option and selling a higher price one. We could look at something like Tesla here and look at a similar spread. We could look at the Tesla. Actually, I had one queued up already. We could look at the July-March 330 spread. Okay, Tesla's 305, so let's put the strike more to at the money. So let's say the 300 strike, okay? So if you were to buy one of the July 300 calls and sell one of the March 300 calls in Tesla, it would cost you $2,500 to do that. And you would collect, according to the sheets here, $13 a day. So you put $2,500 aside and you collect $13 a day. Now, as time goes by closer to that expiration, this number is going to get bigger. In about in like 3 weeks, it's going to double how much theta you're collecting, and it's going to keep getting bigger until you get until that option that you sold in March expires. And I wouldn't probably wait to close the spread out until it completely expires. I might roll that March option out a little bit. But you can trade this in the same way as you trade condors, in that you could have, a little bit of the July-March spread on, and then you could say, okay, well, I'm going to put a little bit of the Jan-April on and have stuff straddled across a couple different months, and that sort of insulates you from like 1 month getting a little wacky or something. And I like this trade because it is an effective use of capital, but the risk is not as great delta-wise as many other trades. If you put this trade on in Tesla one time, yes, you're putting $2,500 at risk, but the delta associated with it is one delta right here. So, Tesla makes a rip up or down one way or the other, you're not going to be blowing out that $2,500. In fact, it would be incredibly difficult to make that whole $2,500 disappear. I mean, I'm showing up 10% here. A person losing $170, down 10%, losing $300. Okay, so hard to blow out your position when a 10% move, is only like $200 loser. And like I said, I would try out some of these calendars, put it on, watch it trade. I put one of these on about a month ago, and the next day it went in my favor by several $100s, and I just took it off. It was unbelievable. Let me see which stock that was on. I'm trying to remember. It was Tilray, I believe. Yeah, it was Tilray. And I put the spread on between some months. Immediately the months adjusted back to a more reasonable level, volatility-wise versus each other, and it was a winner right away. Now, all trades aren't going to be like that. I would be perfectly satisfied if it just followed like the Greeks, like this trade I just did, which is saying it's collecting about $30 a day. And so I put up $1,000, collecting $30 a day, and I figure I'll just leave that, go on and make some other trades somewhere else, and that's just throw it into my portfolio. Let me know what you think about that and what kind of trades you're looking at. And I will probably be coming on maybe a little bit later with a special guest. We've been talking about that a little bit. But I like doing these little options lessons. Tell me what you want to hear about, and we'll talk about that. Kind of sideways market again today. Let's do a quick look at the VIX. VIX down 68 cents, trading 1569. Not really trading. It's being quoted there because the VIX is a number based on a formula. The actual VIX doesn't trade. Let's go to VIX Central, look at the term structure really quickly. And the term structure, we're showing contango of 2.31%. And the spread widening to a very healthy level between spot and the M1 future. Right now, the spread, it looks like it's about $1.20. It's about $1.20, $1.21. Over $1, though, which is healthy. And I can see us adjusting. It seems like we're slowly adjusting more into contango. Like one day we'll have a down market and contango will go down to like 1%. But then we'll have an up market and then contango will expand to like 5%. And then the next day it seems like we're slowly getting into stronger and stronger contango, which is really exciting with UVXY. We did have that pop in the last couple of days where you could jump on the short side if you'd like to. I can see people starting to put on long-term short positions now in UVXY and start to ride this thing down the hill. And, at this rate, we will take out the all-time low sometime this summer. So that's very exciting, and looking forward to that. Thanks for watching, and tell your friends, sign up. Sign up for Gorilla Trades. They've got great stock picks. Sign up for Patreon. Support me there. Follow me on Twitter, and put your own 2 cents in. I love to hear from everybody. I get amazing. I had only less than 100 views on this video that I did 2 days ago, and there's for every 10 viewers, there's one comment or something, which is a huge level of engagement. So thanks, guys, for being engaged with me. I know you guys like to talk about your own positions and share what you're doing and share your opinion of what I have to say. And keep doing that because that's awesome. All right, talk to you soon. I'm going to be coming back on in a few minutes, I believe.